MGX Minerals is revolutionizing the new energy economy with patented lithium extraction technology, replacing traditional solar evaporation using low-cost, low-energy nanofiltration. The first system of this paradigm shift technology is currently being commissioned. MGX Minerals trades on the CSE, symbol XMG, the OTCQB, symbol MGXMF, and Frankfurt, symbol 1MG. For more information, visit our website, mgxminerals.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Wolf Richter. He's the founder of WolfStreet.com. He's speaking to us from San Francisco. Wolf, welcome back to HowStreet.com radio.
Thanks for having me back.
How were auto sales for 2017?
So we had a disappointing December, disappointing for those people that had hoped for better. And in December, total vehicle sales declined to over 5%. So for the year in total, total vehicle sales fell 1.8%. And so this was the first year since the financial crisis when vehicle sales, so this is by delivery, so by actual units delivered to customers. So this is the first year since the financial crisis when vehicle sales fell. For U.S. automakers, so for Ford, GM, and Fiat Chrysler, it was the second year in a row when the sales fell. In 2016, so the year before, overall the market had a slight gain, but it was carried by some of the import brands, and the U.S. automakers already experienced the first loss since the financial crisis in 2017, and for them it was the second year in a row that vehicle sales declined. Overall, in 2017, vehicle sales are now down 1.4% from 2015. So actually the year 2017 took us back 2 years, so we're below where we were in 2015. Much of the truck sales are strong, trucks, SUVs, crossovers, they're hot, they're doing well, their sales are improving. That's the same thing in Canada. What is getting crushed are car sales, and they're down by the double digits. I mean, consumers are switching over to larger vehicles, and so in terms of economical vehicles, that's really that's a bitter pill to swallow for the regulators that are trying to get the fuel economy, average fuel economy down, and it's just a shift in consumer behavior, in part sponsored by cheap gasoline, and but overall the truck sales have not been able to make up for the loss in car sales. And car sales are just really getting crushed. So automakers that are relying on car sales to a large extent are suffering more than those that are really strong in trucks, like GM and Ford are powerhouses in trucks. So they're doing kind of okayish. It's tough.
Well, we're seeing interest rates in both Canada and the U.S. being boosted by the central banks. That's probably not good news for the car makers either, is it?
No, it is not good news at all. And in the United States, we now have a target rate that's up to 1.5%. Auto loans have come up a little bit. What has happened is a lot of marginal sales were accomplished by lending money to subprime rated customers, and the subprime loan portfolios have been deteriorating at a terrible pace. So the default rates of subprime auto loans that were made in 2015, 2016 are very high now. And so lenders are responding, and the banks have already tightened up their subprime lending. Some like Wells Fargo have made a public statement about it, and others have not, but they have tightened it. And so they've gotten that somewhat under control. But the independent auto lenders that are specializing in subprime, that did carry the largest risk, their default rates are just gigantic and growing. And so they're being forced to, by the market essentially, they're being forced to be more careful. So they're tightening the lending to subprime customers, and that's taking a lot of people out of the new vehicle market. So they still can buy, but they just can't buy a new vehicle. They'll have to switch to a much lower priced used vehicle with less financial exposure. So it takes these people out of the new vehicle market, and we can see that. I mean, that's part of the thing that we're watching here, is that the subprime customer, which drove the marginal sales higher, that they're now being blocked from buying new vehicles. And the higher interest rate, that crept up, so it makes it a little bit more expensive. But in terms of subprime lending, it's very expensive if you're a subprime rated customer trying to buy a new car, because number one, it's not like you're paying 4 or 5%, you're paying 15, 16, 18% on some of these loans. You're paying a very high interest rate. You're probably upside down in your trade-in, so you're financing a lot of money, and it makes that whole loan very difficult to sustain on the income that these people are having now. And if they lose their jobs, obviously it's completely impossible. But even if they don't lose their jobs, it's a very difficult thing to do, and it pushes them practically out of the market. So this part is not directly tied to the rising interest rates. This is what we're really seeing in subprime is somewhat unrelated to the interest rates. It's just it was a boom in subprime lending that is now falling apart. The higher interest rates, I think that impact the entire car market, but they're still historically low. If you look at auto loans, they're still very, very low in terms of the interest rates. So, it'll make some difference, and people will switch maybe to slightly cheaper cars. But I haven't seen that trend yet. The sales that we're having are trucks and SUVs, and they're expensive. So people are buying very expensive vehicles.
Is it true that it's not really that much more expensive to make a truck or an SUV than it is a regular car?
Yeah, that is true. In fact, it may be cheaper to build a large vehicle than to build a small vehicle. Or in a small vehicle, you still have all the same parts. You have to put it much more closely together, and it causes some issues and some problems in making it. And you have to use very light materials and to make it a light, economical car. On pickup trucks especially, the technology is rugged but fairly basic. On the suspension side, for example, they have a live rear axle with elliptical leaf springs. These are very cheap to produce suspension parts, and they've been around for 50 years and nothing has changed. But at the same time, a pickup truck is very large now, and especially the newer models. And they have big engines, and they're powerful, and they give people a sense of value. So the profit margins are just obscene on these for automakers, not for dealers, but for automakers. The profit margins on these vehicles, on pickups and high-dollar pickups and SUVs, are just obscene. It's and that's why they love selling them. They're pushing them. They can give $10,000 off if they want to, and still make a lot of money on it. And some of those vehicles, they're $50,000, $60,000, $70,000, $100,000. And the automakers they're loving it. And then you look at the sales, they're going up. And even though when deliveries are falling, given the higher transaction prices based on those more expensive vehicles, the sales are rising, and the gross profits of these manufacturers are rising because, the profit margins are just so huge in these cars, in these trucks. And in cars, cars are made in Mexico in part because you cannot profitably manufacture an economical car, a cheap car in the United States. There's just not enough profit margin in it, and it's too expensive. And that's why most of the manufacturing in cars has shifted south.
Car makers seem to be raising their year-over-year prices faster than inflation. Why are they doing this?
Because they can.
I didn't want to say that, but
it's really amazing. Sales are declining in unit sales, and prices are going up. And at the same time, automakers are offering record incentives. And this is somewhat of a puzzle. the automakers could cut their prices. They could cut their sticker prices if they wanted to, but they're not doing that. They're raising sticker prices, especially on trucks and SUVs, and they have been doing that in leaps and bounds. And if they bump into resistance, they give temporary or one-time discounts that they can stop anytime they want to. So the sticker price goes up, but if sales slow down, they'll have some kind of dealer incentive or customer rebate or something that is trying to bring the pain down to a level where customers can endure it. There have been CEOs that have said we've pushed this too far. The problem in the industry is that we've made these vehicles too expensive, and we've thrown the price increases to an extreme, and now we're running into a problem, and now we have to give these big, massive discounts. And transaction prices, despite those record incentives and discounts, are at a record. So in terms of trucks and SUVs, they've never been higher, despite the discounts. Yeah. So this is the conundrum the industry is facing. It has had 8 boom years. It has raised prices throughout those 8 years at a significant pace for vehicles that are selling, so the trucks and SUVs. And now it's running into resistance, so it's giving out record incentives, but still raising prices. So, and, it's working for the automakers for now because, sales are down a little bit, but if they raise prices enough, their dollar sales will actually come out ahead. So at this point, they're raising prices because they can still. And at some point, maybe they'll have to switch, but you can't really lower the price, the sticker price on a new vehicle, because it will crash the used vehicle market for that brand. And, so that's probably not going to happen. They will probably continue to try to stimulate sales with record incentives and discounts rather than actually cutting the sticker price. That has never really happened, and I don't see that happening either. I mean, it's just that is very difficult to do for fleet owners. They'll hate you if you do that. Used vehicle or current owners hate you if you do that. Everybody will hate you except the current car buyer. So I think they will stick to incentives to try to move the market.
We'll have more with Wolf Richter right after the break.
Glance Technologies owns and operates Glance Pay, a disruptive mobile payment technology now live in 16 cities in Canada and about to launch in the U.S. With revenues up 664% in the last quarter, Glance Technologies has the potential to be a worldwide leader in an industry projected to grow to $1.3 trillion in 3 years. Glance Technologies stock symbols are GLNFF in the U.S. and GET in Canada. Find out more at glancepay.com.
Hi, I'm Douglas Mason, President and CEO of Magnum Gold Corp. Inc., MGI on the TSX Venture Exchange. A 2015 drill program on the LH property intersected high-grade gold, including 16.9 meters of 13.58 grams and 11 meters of 20.66 grams per ton gold. A follow-up drill program is planned to further evaluate previously identified subsurface high-grade gold mineralization. Please visit our website at magnumgoldcorp.com.
Welcome back. We're speaking with Wolf Richter. Wolf, have we seen any of those hurricane-damaged cars crop up across North America yet, or trying to be foisted off as just mildly used?
Yeah, they have entered the system, and they're in the system. Some of them have ended up on the junkyard, and others are being reconditioned and sold. Those that have been totaled by insurance companies, they should have a flood title, so it should be marked that they were totaled due to the flood. But many of the cars that were flood damaged didn't have insurance, so insurance company never totaled them, and it's up to the owner to decide what to do with it. And so if they can drive, they can clean it up and drive it for a while, or they can sell it or whatever. It will not have any official marks as being flood damaged. And these cars have entered the used vehicle market. They're everywhere.
Are banks starting to constrict credit, and what does that mean for the auto market, apart from higher interest rates?
Yeah, banks have constricted the subprime part of the market. And on the prime lending, they're still very aggressive. So they have not really slowed down the lending. The economy is strong. People have jobs, so they're not worried about getting the loans paid back from people with good credit ratings. But the subprime auto loan market has essentially blown up, and because there's some high risk players that entered into it, some lenders that specialize in subprime, the non-bank lenders that specialize in subprime lending, and they've done some very reckless things with them. They also securitize these subprime auto loans into asset-backed securities. Some of the tranches, so these loans are sort of sliced and diced and sold in tranches, and some of the tranches are rated with AA ratings, and so investors really appreciate that. But a lot of that risk is now coming home to roost, and the market is really tightened on that. So the subprime market is most decidedly tightening on the lending side. In terms of the prime market, I have not seen any tightening so far.
Is the health of the vintage car market a good economic indicator?
I'm not sure it's an economic indicator. I think it's a financial indicator more than an economic indicator. Because these people that invest in those cars, many of them are reasonably independent in terms of the wealth of the economy, but they're very worried about asset prices. And what has happened in vintage cars is that their prices peaked in August 2015, and they have surged. The financial crisis it sank all asset prices, and so vintage cars too, they came down 16% during the financial crisis until the Fed started opening the spigot, and that levitated everything, and especially vintage cars. And so they soared, prices soared, inflation adjusted. You're looking at a gain of 54% from the prior peak by August 2015. So this was a huge gain adjusted for inflation. Now, since then, prices have come down 17%. So that is a larger decline than the market experienced during the financial crisis. During the financial crisis, the market prices came down 16%. Now they're down 17%. And it's also been going on for longer. August 15 through now December 31st. So you're looking at quite a while now. During the financial crisis was a year. Now it's a little over like 14 months. Now we're looking at, it's going to be close to 2 years. So it's definitely an interesting phenomenon from a financial point of view, because this is an asset class. It's a fun asset class like art. People like to do that. They like to show these cars. Some of those cars are worth millions of dollars. One of the most expensive cars ever sold was the Ferrari 1962 Ferrari GTO that sold for like $38 million. So these are expensive pieces that people never drive. They sit in air-conditioned living room type environments, and so that they're protected and insured and so forth. So this is definitely an asset. It's not a it's not a car that you drive. And so what causes people in the market to shy away from driving up prices further? What causes them to try to sell the assets? And what causes others that are buying to be hesitant to spend more money on these vehicles? And so they're looking at the same numbers that we're looking at, which is a large increase in prices. And they're figuring, okay, the Fed is tightening now. August 15 was just right. That's the peak of those prices. That was a few months before the Fed started its rate hike cycle. It started in December 2015. That's when it made the first tentative rate hike. So by that time also QE had stopped. So they kind of knew what was going on, and maybe that's the smart money that buys these cars, and maybe it predicts what financial markets will eventually do. During the financial crisis, it was sort of simultaneous with the stock market. There was not a huge timing difference. The stock market, actually, the classic cars were a little lagging by a few months, but that's really, it just depends on the auctions and so forth before these numbers show up. So it's not necessarily a good predictor, but I think it shows that people that are investing are worried about bubble pricing in various asset classes, and one of the more illiquid things is are these cars. When the market turns south really in a serious way, you can't sell those cars. I mean, there may be buyers out there, but not at a price that you can survive. The liquidity just disappears. So you really only can sell these cars in a thriving market, in a hot market. When the market cools, it gets very difficult to sell these cars at a decent price. And most of the time, when you don't get what you want, you'll have to hang on to the car. So, and that's what people are doing. The sales sort of dry up unless they have to sell.
We'll have more with Wolf Richter right after this.
Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp, RMO, on the TSX Venture Exchange. Rainy Mountain's Brunswick property is located in the Rideout Shear Zone in Ontario, with grab samples running as high as 32 grams per ton gold. A follow-up drill program to test numerous targets located by recent groundwork is planned for early 2018. Please visit our website at rmroyalty.com.
Keep informed. Receive our weekly recap of thought-provoking articles, podcasts, and radio delivered to your inbox for free. Sign up for the HowStreet.com weekly recap on our homepage, HowStreet.com. Welcome back. We're speaking with Wolf Richter. Wolf, are cryptocurrency markets correcting right now, or are they crashing?
Well, they crashed, and now they're bouncing some. Correcting is maybe not the right word to use, because when a market corrects, the implication is that there is some kind of economically reasonable value that they correct to. So in bonds, that would be a yield that makes sense, or in stocks, it might be dividend yield, or it might be some other metric like earnings per share or something. In cryptocurrencies, there are no metrics. So there's no economically reasonable level that they can correct to. There is no underlying value. There's no yield. There are no dividends. So and there's no economic use like in commercial real estate. You can there's economic use for these properties. So cryptocurrencies don't have any of this. So they're kind of in sort of in a vacuum, and that's why I hesitate to use the word correct, because it correct to what? There's no real correct, there's no such thing as a economically correct level for these entities. At the same time, they have seriously crashed, with Bitcoin down over 50%, and Ripple, one of the other largest cryptos out there, down like 80% at one point. Some of them, BitConnect, for example, has gotten entangled in all kinds of allegations, and the regulators are forcing it to shut down some of its operations, and so it has plunged a lot further than that. So this was a day ago, like as soon as you get through finishing that sentence, the values have changed dramatically, and like Ripple went down, 80%, but since then it has doubled. So it has doubled, but it's still down a whole bunch from its peak. It's still down like 50% from its peak. So it is just extraordinary how rapidly the values of these tokens and these cryptos change, going up and down by 20, 30, 40, or 50% in a single day. And so it throws this whole entire conversation as to, is it a bubble and will it correct, into a sort of a state of confusion, because you can't describe it as a bubble, because a bubble assumes that there's an actual value which it now has exceeded by a fairly large amount, and you can't describe it as a correction because there's no correct value. So they're really in a very unique vacuum, and so the prices are not handicapped by any kind of metric, and they can go up and down in leaps and bounds that are really unthinkable for assets that we have come to see as volatile, such as stocks and other things. I mean, the stock, one single company stock, can go up and down quite a bit, but overall the market wouldn't move that much. With Bitcoin, with cryptos, the entire market moved, and by 50%, and jumping back. And within the market, there's now 1,400 of these cryptos and tokens out there. Last time we talked, there were about 1,000. So anybody can create them. Anybody creates them. I mean, next time we'll talk to maybe 2,000 out there. So there's an unlimited supply of them, and and it's just it's happening in a vacuum without any kind of metrics to support it. At the same time, there are no metrics to stop it. There's no telling where this will go.
What's the latest on the U.S. commercial real estate markets?
Yeah, so unlike cryptocurrencies, real estate is very much bound to the real economy. And real estate prices in the United States have been soaring since the financial crisis. Depending on what indexes you look at, they peaked in September 2007, and then they crashed during the financial crisis by a very large amount. And then they went on an 8-year boom. The boom sort of started plateauing in June 2016, and in December it ended a year that was the first down year since the financial crisis. It wasn't down a whole lot. It was down a smidgen, but it was the first year since the financial crisis that there was no increase. It was just like decrease in commercial real estate prices across the United States. And this is all classes of commercial real estate combined. They're within the categories. There's some big differences. Brick and mortar retail, as we know, is in deep trouble. So these prices are down in the double digits, with mall owners really suffering, especially B and C malls, lower rated malls. Some of them have turned into zombie malls, and there's no retail use for them anymore. They have to be essentially plowed under and repurposed so that it makes, put housing on it or something, make something different out of that land. And in terms of the structures that are on it and everything else, it's essentially worthless. What has value is the land, and it no longer produces any income. So brick and mortar retail is dropping sharply. Self-storage was an enormously hot segment in commercial real estate, and probably the hottest segment of them all. But it hit a ceiling and is now down 2% for the year. If you drive around anywhere in the United States, in San Francisco or anywhere really, I mean, there's self-storage places everywhere. And for some reason, it was thought that there would be unlimited supply of people needing self-storage, and that's not the case. So the demand for self-storage is there, but not for as much as they have built up for. So right now, the market is overbuilt, and prices are coming down. Lodging, so hotels, etc., they took a big blow a couple of years ago in 2015, from which they never recovered. Already back then, they just barely made it up to the peak of the financial crisis. The sector is under heavy attack from Airbnb and other home sharing organizations, where tourists and even business travelers are switching more and more to vacation homes. then plus it's overbuilt. I mean, they're still building hotels everywhere. So, I mean, the lodging sector, I think, will continue to be struggling. Industrial, so that's warehouses, and warehouses are hot now, and that's part of the e-commerce boom that we have in the United States. We don't know the final figures yet for the holidays, but Adobe indicated that e-commerce sales were up 18% over the holidays, and that makes sense. I mean, e-commerce is just incredibly booming. What it does, it takes sales away from brick and mortar retailers, and it involves an entirely different infrastructure in terms of delivering the merchandise. So now Amazon has a huge and growing portfolio of fulfillment centers around the country in every major city, and they have smaller ones and larger ones, and other retailers do the same thing. Walmart is closing a whole bunch of its Sam's Club stores, and some of them it's converting into fulfillment centers for its e-commerce operation, which is thriving. And Walmart sales are not doing that well, but its e-commerce division is doing very well. Macy's the same thing. I mean, all these retailers that are switching to e-commerce, they need to put the infrastructure in place to deliver the merchandise, and part of that is industrial. So that part of that is the warehouses and fulfillment centers, and they rose nearly 10% for the year in terms of price. I don't see that backing off at this point. I mean, that's just really doing well. And the apartment sector is just barely hanging on, and they're overbuilding in many cities. A lot of overbuilding going on in Seattle, in Denver, in San Francisco. I'll tell you, I mean, the housing crisis that we have in these cities is that whatever gets built is high end, and people can't afford it. At the same time, these high end apartments sit vacant. And so the apartment sector is flat for the year, and in some cities it's starting to have a problem. The office sector is still doing pretty well. Now, office in the trophy market of Manhattan and in some other places is showing a real problem. And so let me just get specifically into Manhattan. That is number one trophy market in the United States in the office sector, and so it was the number one magnet for Chinese companies to get some money offshore and invest in it. And in the second quarter this year, half of the major office buildings that sold in dollar sales were acquired by Chinese buyers, so by Chinese companies. And they saw some of the money from Western lenders and some of it from Chinese lenders. So it wasn't all Chinese money, but it was Chinese companies buying these office buildings, including H&A, which bought the most expensive office building in the second quarter, spending $2.2 billion for it. In the third quarter, that stopped. And in the fourth quarter, there were no Chinese buyers in Manhattan of major office buildings. It just dried up. And this is a consequence, in part, of the Chinese government curtailing capital flight and trying to keep companies from investing in frivolous projects overseas. And China has issued some guidelines on that, and it's strictly controlling it. It's even controlling the overseas subsidiaries of Chinese companies, what they can and can't do. And real estate has been particularly targeted and has been named as one of the line items to be targeted. And so there have been no major office buildings sold to Chinese buyers in the fourth quarter in Manhattan. And so in total, there were about $11 billion in sales in the fourth quarter in Manhattan. That was down 43% from the fourth quarter.
Does the U.S. still need to rely on China to buy U.S. Treasuries?
It really doesn't rely on it. It's a nice thing to have. And if push comes to shove, the Fed can always buy Treasuries, and it does, or it has in the past, And so the theme that without China, the United States would go bankrupt. That theme doesn't hold up because we print our own currency. So the Fed is the lender of last resort to the United States government, and so it will always be there. Now, if the Chinese the Chinese have not increased the level of U.S. Treasuries, at least those that we know of that are held at the Treasury. It's around $1 trillion. Has been around $1 trillion, a little over $1 trillion for a number of years. They may hold other Treasury securities in Belgium and in other markets where through a fiduciary where we don't know. So they may have a little bit more than that. But that's what we know. And so they really haven't increased their holdings in past years. They've just kind of maintained it. And it's going up and down a little bit. When Treasuries, when the appetite sort of wanes, and let me point out something, today the 10-year Treasury yield closed at 2.62%. And that is a major step higher than what it was before the holidays when it was down to 2.3%. So the yield is going up on these long-term treasuries. The short-term treasuries, they have been, the yields have been going up with the rate increases from the Fed. So the market has been following that. On the long-term end, the market has been defying the Fed until now. So now the market is starting to do a little bit of catch-up, and the long-term yields are coming up. When yields go up, means prices go down. So the bond market, the Treasury market, has been going down, and its yields go up. So when yields go up, it becomes more attractive actually for buyers. So at a certain point, even if the Chinese tried to get out and the yields rise to 3.5% maybe, or more, at some point, those 10-year Treasury yields will become very attractive to the entire world. And buyers would swarm, and that's what happens. When yields rise, eventually buyers come out of the woodwork and buy them because they're very good securities in terms of for conservative investors. And if the yield goes up a little bit, these investors will come out of the woodwork. So I don't think the Chinese can disrupt that market, as some people are threatening. I think the yields will go up, prices will fall. We've seen that, and I think that's continuing. It has been a big move on the short end of the curve. So the 2-year yields, they went from almost 0 to over 2%. The 10-year yields are now coming up. They could hit 3% in a few months, and maybe sooner. They have come up so far in the last 5 weeks, that I think, there could be some dramatic change. At some point, it's going to impact other asset prices. Rising 10-year yields impacts mortgages, impacts the housing market, impacts the stock market. So this will spread around a little bit. But the Chinese, I think, the Chinese have not been a huge factor in buying Treasury securities. They have been for the last few years. They have had a level of around $1 trillion that has remained kind of steady. So I don't think they've actually impacted the market that much.
Is the bond market still in a bubble?
Yeah, the corporate bond market, decidedly, the junk bonds have very low yields right now. The Treasury market, as I just mentioned, the Treasury market is declining. The prices are going down. Yields are going up. That's really not the case yet with junk bonds. They're incredibly high valued. Yields are very low. Higher rated corporate bonds are still very strong. So the moves in the Treasury market haven't really been reflected in the corporate bond market. So money is still extremely easy in the real economy for these companies. They can borrow, they can issue bonds at very, very low rates. Even junk-rated companies can borrow at relatively low rates, historically low rates, really. And so, yes, in terms of the corporate bond market, it is still in a bubble, and it will eventually follow the Treasury market.
Your thoughts on the U.S. dollar?
It had a terrible year in 2017, and 2018 it's even worse. So it went down further so far this year. What the Fed has been doing is supportive in theory of the dollar, but the dollar was very strong the prior year. So I mean, there's always some give and take. I think as we go deeper into 2018, the damage to the dollar is likely coming to an end. The Fed is good and pretty hawkish, and the verbiage that's coming out of it, it is, the markets have been brushing it off, but eventually it will settle in. And as long as the dollar is weak, the Fed has no reason to worry about it. It worries about it when the dollar gets too strong. So the hawkish language coming from the Fed is in part supported by the weak dollar. They're watching the dollar not reacting to exchange monetary policies, and so they know they can push higher and faster if they want to. And at some point when the dollar gets too strong, they may have to back off with the tightening, but that's a long ways off. So I think right now the Fed is using the weak dollar to be hawkish, but at some point this is going to stop. You can't. I think the markets will at some point will react to the higher interest rates in the United States and to the unwinding of QE that's taking place. And the ECB is also contemplating ending QE, and the Bank of Japan has already ended it. So I mean, they're doing things that could strengthen their currencies, but they're lagging far behind what the Fed is doing. So I think later this year the dollar will gain some strength.
Are bankruptcies on the rise in the U.S.?
Yeah, so bankruptcies bottomed out in about 2014, and then came the energy bust, and so we had a big boom in bankruptcies from the oil and gas sector, and so that faded out, and then came the brick and mortar retail bust, and that's still going on, and we had a surge in bankruptcies. But then in December, just in the month of December, bankruptcies, Chapter 11 bankruptcies spiked by over 100%. So doubled compared to a year ago. Chapter 11 in the U.S. Bankruptcy Court law means that companies try to restructure their operations. So they're renegotiating their debts. They're probably handing the equity over to creditors, so shareholders will end up with nothing usually. Some creditors will end up with nothing. Other creditors will get something, and then some of the more secured creditors will be made whole. The idea is to allow the company to emerge from bankruptcy in better shape, with less debt and in trimmed down format, so it can compete more aggressively. And so these Chapter 11 bankruptcies, having doubled in December, was an eye opener. This does not happen. December is normally one of the low months. Bankruptcies are seasonal. They usually spike during tax season, so February, March, April, going to May, and they usually hit a low point at the end of the year. And typically bankruptcies fall from November to December. They jump from November to December this year, and the 100% spike in bankruptcy in December brought the December level to the highest level since like 2013 for any month. And it was just extraordinary. So the question is, what causes this? What caused the spike in bankruptcies, of Chapter 11 bankruptcies? And overall bankruptcies for businesses ticked up a little, 2%. So that was kind of in line with the recent trends that bankruptcies are going up a little bit. But these Chapter 11 bankruptcies, why would they jump so much? And the only answer I could come up with is that, in fact, it has to do with the changes in the tax law in the United States, where the corporate tax rate got cut from 35% to 21%. So if you have a write-off and you can take the loss in 2017, it means that the government would pick up about 35% of that loss via lower taxes, whereas in 2018, the government would only pick up about 21% of that loss. So I assume that a lot of PE firms and other companies that own companies that are in trouble, or that they decided to declare Chapter 11, to file a Chapter 11 bankruptcy in December in order to support their loss claims for 2017 and not allow them to move into 2018. And that's my only explanation that I have. I mean, if you have a doubling of the bankruptcies like that from one year to the next, it usually doesn't happen unless the economy completely craters. And that's not the case. The U.S. economy is doing fine. There's no collapse of that type going on. So it has to be a tax reason. And we'll see. If in January and February bankruptcies spike again by 100%, then this theory is wrong. We have a huge problem on our hands. But I would expect the January and February numbers to come in at a more normal level.
The Bank of Canada raised rates again yesterday, 1/4 point. Are Canadian banks making it harder to borrow money?
In Canada, in terms of consumer lending, the big segment is mortgages and HELOCs, and they're getting more expensive. So the stress tests are being required now already make it harder for home buyers to qualify for mortgages. The rate increases make it more expensive. So, and they make it more expensive for all homeowners that have variable rate mortgages. So I think this will have an impact on overall lending. Now, if one bank tries to tighten, there'll be another bank that's trying to take advantage of that. But I think that the trend is a gradual tightening of the lending environment, in part forced by the stress test, and it will be more expensive to borrow. That's for sure, and it will also make HELOCs, for example, more expensive. And so I think there will be some gradual impact on the lending environment.
As Canadian real estate prices decrease, will negative market psychology set in, causing prices to go lower and lower?
Yeah, I'm not sure exactly at what point negative market psychology kicks in. It does kick in eventually. We have seen that during the housing bust in the United States. At first, housing was set to plateau. And then it was described as just a normal decline in the correction. And at some point along the way, it turned into a psychological thing, in addition to being a real economy thing, that people lost their jobs and couldn't make their payments. That's when the real economy and psychology collide, when people just cannot make their mortgage payments. If house prices plateau, it might take some of the enthusiasm out of it. If people realize that you can't make 30% every year on your condo, but this will take a while to play out. There will have to be some real declines, I think, before that becomes a major factor in the market. At first you have to have a recognition that housing is no longer the guaranteed moneymaker that it was last year, and that it was for the last 10 years, 20 years. That recognition hasn't set in. We're far from that. Most people in the market right now just think of it in places where prices have gone down, and in, like in Toronto, prices went down from the peak in April, but they're still above where they were a year ago. So in Vancouver, detached house prices are not doing all that well, but condos are really hot. So and in some other markets in Canada, the prices are a little lower, a little higher. So it really hasn't reached a point where where there's a broad-based misery among home buyers. And now there's just some questions in the market, and people are still thinking, yeah, this is going to turn around. It's going to get better, and we're going to make 30% next year. That's still there, and so I don't think that psychology will change this quickly. It takes a long time. It took a long time in the United States, and it's a matter of years, not of a few months.
How can people find out more about Wolf Street?
Everything we have is on wolfstreet.com. Everything is free.
Wolf, thank you so much for chatting with us.
Thank you, Jim. Great pleasure.
My guest has been Wolf Richter, publisher of wolfstreet.com. He was speaking to us from San Francisco. If you have any questions for Wolf or any of our other guests, you can send them to info@howstreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.